Obvious question here. Are you psyched up about the S&P 500 hitting the 5,000 mark, or do you see some signs of concern in the market?
Well, I see both, actually. And from our perspective, we look at it. Earnings season, Q4 earnings season for the S&P 500 has been thus far much better than expected. Four sectors showing double-digit earnings growth, and they include communication services, consumer discretionary, information technology, and utilities. And you have the auctions are, well, they get a little bit wonky here of the bonds. They're still selling U.S. bonds, or there are buyers for them, and likely we believe a continuation of innovation to carry this market. That doesn't mean we don't get some questioning of it, and that's natural.
Okay, well, what are the questions then, John? Again, S&P 500 hitting the 5,000 mark, and we are actually seeing a broadening of the market. We've been talking about it earlier this week. We saw healthcare and also industrials hit highs.
Yeah, we sure have. And the good news about that in particular, with industrials, this is the year that the big spend should really begin to flow through all the spending that the politicians on both sides of the aisle have done in preparation of building infrastructure in the U.S. So this should be good for industrials. And the broadening of the market, really, to us, we've been accumulators of industrial stock for quite a while, whether it's defense, whether it's commercial, airspace, whether, it's
well, John,
a lot
what are
of
the questions then? It sounds like everybody's on the same page. Market just moves higher from here, right?
Well, but the real question is, what about valuations? Also, we've had a tremendous run-up since October of last year. With the technology leading what has been mostly a very narrow rally. But the broadening is a good sign. Yesterday, we've got to say, when we looked, and there was very modest gains in the S&P and the industrials and in the NASDAQ. But the smalls and the mids, all of a sudden, there was life there. So we think combination of good Federal Reserve policy, we think fewer cuts, more pause. That looks good. And business, the consumer, as well as labor, all doing very well here relative to where we are today. We'd say resilience remains the operative word.
Resilience is your operative word. I do want to ask you about your forecast when it comes to those Fed cuts. You're saying a total of 50 basis points to 100 basis points in cuts. You're certainly on the more conservative side of the spectrum. How does that impact the market? Does that, in your mind, the fact that we're only going to get those cuts when the market's expecting quite a bit more, does that hurt this long-term story?
No, if anything, I think it keeps near term. It keeps people keeps people honest. It reduces the potential for irrational exuberance at this point. So what we would think it'll be a more thoughtful broadening of the rally as we go forward. Less irrational exuberance. Interest rates are high enough, so margin players, the deeply levered players, are at least put off somewhat by that margin cost.